Ladies and gentlemen, good day and welcome to the Vaibhav Global Limited Results Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Concall of CDR India. Thank you, and over to you, sir.
Thank you, Melissa. Good evening, everyone, and thank you for joining us on Vaibhav Global's earnings conference call for the quarter and the financial year ended March 31st, 2022. Today we have with us Mr. Sunil Agrawal, Managing Director, Mr. Vineet Ganeriwala, Group CFO, and Mr. Prashant Saraswat, Head Investor Relations. We will begin the call with opening remarks by Mr. Sunil Agrawal on the business operations, key initiatives, and a broad outlook, followed by a discussion on the financial performance by Mr. Vineet Ganeriwala. After which, the management will open the forum for a Q&A session. Before we get started, I would like to point out that some statements made or discussed on today's call may be forward-looking in nature and must be viewed in conjunction with the risks and uncertainties that we face. A detailed statement and explanation of these risks is included in the earnings presentation, which has been shared with you all earlier. The company does not undertake to update these forward-looking statements publicly. I would now like to invite Mr. Sunil Agrawal to make his opening remarks. Over to you, Sunil.
Greetings to all, and thank you for joining us today in earnings conference call of Vaibhav Global Limited for the quarter and financial year ended 31st March 2022. I hope all of you, your colleagues, and near and dear ones are healthy and keeping safe. We delivered revenue of rupees 685 crores for fourth quarter, up by 2.9% YOY, and closed the fiscal year with 8.4% revenue growth, which is in line with the guidance we set out in Q3. The revenue growth is more encouraging when we compare it with Q4 of FY20 and full year FY20, which is 37.6% and 38.6% respectively. We maintained our gross margin at 60% in Q4 and 62.3% for FY22, which is at par with FY21. Our industry-leading margins are made possible because of high product mix, efficient price management, efficient planning, in-house manufacturing, and wide sourcing base. EBITDA margin for the quarter was 6.9%. Excluding Germany, it would have been 8.9% versus 12.8% last year. This reflects the impact of accelerated investments in digital marketing, marketplace marketing, and increased airtime on OTA platforms. In FY22, our unique customers were flattish over FY21, owing to large number of customers who bought essentials in pandemic times. Our investments on digital platforms are generating desired results in terms of higher new customer acquisition. New customer acquisition on TTM basis stands at 2.3 lakhs. Adjusted for essentials, it is higher by 15% over FY21 and 60% higher over FY20. FY22 was a year of investments for us, wherein we made long-term investments in building our digital competencies, automation, channel upgrade, and geographical expansion. We continued with our planned investments in new OTA homes, elevated digital marketing spends on OTTs, social media search, and third-party marketplaces. We believe these investments to be necessary for future growth and offers long-term profitability prospects. For instance, lifetime value of an OTT customer is almost 5 times more than a TV customer. We also invested in our tech infrastructure, where we upgraded our website in the US, moving into Salesforce Commerce Cloud, and upgraded our mobile and OTT apps in US and UK. In UK, our free channel upgrade to channel number 22 from erstwhile channel 50 is yielding improved viewership and increased new customer acquisition. We expect this benefit to sustain for long time to come. Implementation of robotics automation at our UK and US warehouses has started to yield positive results, with complete benefits occurring in coming quarters. Germany has also been faring well, and its performance has been as per our plan. We are expanding our customer funnel there through continuous onboarding new and prominent transporters, OTAs, social, search, and marketplace platforms. We continue with our guidance to achieve break-even in Germany by H2 of FY24. During the quarter, Shoppers has finalized architect for its upcoming headquarters in Austin, Texas, with expected completion by H2 of FY24. This investment is expected to provide cost optimization, functional integration, and result in growth opportunities. VGL Group has also completed acquisition of MKS Packaging Private Limited. This acquisition will further strengthen our supply chain network, providing requisite flexibility, cost advantage, and sustainable packaging. Our vertically integrated supply chain network spanning 30 countries is the backbone of our business and a key differentiator vis-a-vis our peers. The low-cost manufacturing with value sourcing enables to serve affluent but value-conscious customers in our addressable markets in US, UK, and Germany. This helps achieve industry-leading gross margins at VGL. Further, the 4 R's, widening reach, new customer registration, customer retention, and repeat purchases remains to be our key priorities for overall growth. The reach of our TV networks by end of Q4 FY22 was approximately 124 million TV homes, which is 19% higher YOY. We reach TV homes through cable, satellite, telco networks, and over-the-air antenna, also called OTA platforms. Our products are also available on digital channels, including proprietary websites, smartphone apps, OTT platforms, and marketplaces. New registrations in trailing 12-month period came in at 3.2 lakhs. The number was slightly higher last year owing to essential customers. As of end of FY22, we registered an average purchase of 27 pieces on TTM basis by our customer, which is at par with FY21. Our customer retention rate stood at 40% on TTM basis, vis-a-vis 51% of last year. The retention ratio is lower YOY, as last year had a wider base of customers who bought essential items. Recently, VGL has been conferred with IGJ award by the German Jewelry Export Promotion Council, also called GJEPC, for being the brightest or being the highest exporter of silver jewelry from India, and this is the 6th time in a row that VGL has won this award. Sustainability is at the core of everything we do, and the same is reflected in our mission and guides our decision and action. We are delighted to announce that recently we issued our maiden interim ESG report showcasing our efforts on sustainability factors and our long-term goal along with plans to achieve them. VGL distributed 84 two-wheeler electric vehicles to its employees for their commute without any cost. These EVs will enable to sequester approximately 25 to 28 tons of carbon every year. Another important aspect of sustainability efforts is our 1-for-1 midday meal program, Your Purchase Feeds. Recently, we have crossed a milestone of 63 meals with a run rate of 59,000 meals donated every single school day. We'd like to reiterate that there are multiple levers for our future growth, and we are doubling down on our efforts through various strategic investments. In our addressable markets of US and UK, inflation has reached its multi-year peak levels, which could soften the consumer sentiments. We, however, perceive this as an opportunity for us, as this may result in down trading by our customers due to shifting demands for value products from branded ones, and we are well positioned to cater to this possible economic environment. During last few months, despite industry-wide supply chain constraints, we were able to operate uninterrupted owing to our vertically integrated supply chain. Further, our omni-channel model facilitates a greater level of engagement and provides deeper value propositions to our customers. While the greater economy is grappling through inflationary pressures, demand and cost challenges, we being very clear, we are optimistic on medium and long-term growth journey of VGL and would like to reiterate that our long-term investments would support our growth ambitions. Supported by our value positioning and integrated supply chain, we are confident to combat the inflationary challenges and deliver continued growth and expect current financial year to have mid-single digit revenue growth. However, our outlook for medium to long term remains unchanged, and we are confident to maintain and deliver our original guidance of mid-teens growth. We remain cautious of the ground development and will take informed business choices accordingly. We will keep our focus on growth and profitability with prudent capital management. We have a healthy cash and bank balance, which we will deploy prudently, considering future growth drivers and efficient operations. We are evaluating avenues to provide more value-conscious options in these times while maintaining overall profitability and healthy cash generation. We have a robust cash flow model and track record of returning meaningful cash to shareholders. The board has paid dividends of rupees 4.5 per equity share during first 9 months of FY22 and have further recommended final dividend of rupees 1.5 per share for this year. With this, I now hand over the call to Vinny to discuss financial performance. Over to you, Vinny.
Thank you, Sunil. Good evening, everyone. A warm welcome to Vaibhav Global's earnings conference call. We hope everyone is staying safe. I hope you have reviewed the financial results and the presentation. While Sunil has given an update on operational performance and key initiatives undertaken during the year, I will now take you through our financial performance for quarter and financial year ending 31st March 2022. As Sunil mentioned earlier, the revenue growth got softer during the quarter owing to various macro headwinds. Still in line with our guidance, we delivered revenue growth of 2.9% in fourth quarter and closed the financial year 21-22 with a growth of 8.4% year-on-year. When we compare these numbers against FY20, growth rates are significantly stronger with quarterly and annual growth of 37.6% and 38.6% respectively. In local currency, Shop LC US and Shop TJC UK revenue degrew by 2.3% and 7.1% respectively in Q4. However, the growth was robust when compared with Q4 FY20 and was 25.8% and 25.2% year-on-year over FY20 respectively. In full year FY22, in constant currency, Shop LC grew by 4.8% year-on-year, but it was 28.1% over FY20. While UK was flat year-over-year in FY21, over FY21, over FY20 it grew by a strong 32.3% in constant currency terms. With economies opening up and people moving to in-person shopping after a sharp jump towards digital medium a year ago, we faced macro headwinds after tailwinds of last year. But we believe this is a temporary aberration in the ever-increasing digital transition, and at the same time are taking strategic steps to utilize this opportunity to serve customers with expanded value proposition and filling product gaps. Our preview channel upgradation in UK has positioned us in close proximity to market leaders. This is expected to further strengthen our channel's visibility and enhance the viewership substantially. Revenue from TV was flat at rupees 416 crores, although on a very high base of last year. Digital revenue grew by 3.5% year-on-year, suggesting positive traction and reassuring our investments on digital platforms. Sales mix of digital continues to improve, which currently is at 37% versus 22% 5 years back. TV includes customer accessing our products through our proprietary TV channels reach their homes, both on conventional TV media as well as free-to-air channel on OTA platforms. While digital includes online purchases on our proprietary website and apps, apart from popular marketplaces and social commerce. Our core focus is to promote and encourage customers to transact on both TV and web platforms, which gives them a unique shopping experience, and such omni-channel customers tend to have a significantly higher lifetime value than customers that buy only on TV or only on web. Revenue mix of budget pay has improved by 300 basis points to 39% in FY22 against 36% in FY21. Fashion jewelry accounts for 70% of our retail sales, while non-jewelry maintained its share at 30%, implying segment-wide growth in this year. The non-jewelry segment comprises lifestyle products, which includes home decor, apparels, beauty care, hair care, and accessories. Gross margins continue to remain at 60% and above levels, which is attributable to our strength of having a vertically integrated supply chain. Drop in EBITDA margins reflects our planned OPEX investments on digital marketing, marketplaces, increased airtime for OTA platforms, and our initial setup cost of Germany. We are optimistic of reverting back to our earlier levels of mid-teens EBITDA margin from next year, led by continued customer growth, improved productivity, and cost optimizations. We have undertaken a cost optimization program in the recent times and are expecting annualized visible saving of $6 to $7 million through these cost efficiency initiatives taken during the last few months. Profit after tax for the quarter is rupees 27 crores versus 56 crores year-on-year, owing to earlier discussed increase in investments and headwinds. Adjusted for loss in Germany, PAT for the quarter would have been rupees 41 crores. Operating cash flow of rupees 86 crores in March 22 reflects impact of higher inventory, part of which is because of higher transit inventory, because of port congestion and lack of air freight capacity. Negative free cash flow is on account of planned capex towards technology infra upgrade, warehouse automation, Freeview channel upgrade in UK, new headquarter in US, and initial setup cost of Germany. However, in spite of these investments on TTM basis, our ROCs and ROE continue to be strong at 31% and 23%. And this reflects our short-term impact of conscious business investments, though they are still at par with normal pre-COVID years. The board has paid dividends of rupees 4.5 per equity share during the first 9 months of FY22 and have further recommended final dividend of rupees 1.5 per share for the year. Towards the end, I would like to say that we are confident to continue our growth trajectory with healthier margins in the long run. Our current investments will help build on significant opportunities in the medium and long term. With this, I hand over back to the moderator.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, you may enter star and 1. We have the first question from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Yeah, thank you for the opportunity, sir. My question is with respect to your growth guidance for 23, which is mid-single digit. It means that it doesn't factor any revenue accretion from our new geography in the assumption. That's how it is. And when I'm trying to then correlate with the mid-teen margin, which were our original margin before we went into the new geography and the cost associated with it. So if we have a mid-teen growth assumption, I couldn't correlate with the mid-single digit growth assumption revenue. I actually couldn't correlate with the mid-teen margin. So if you could help us understand these two growth guidance assumptions of yours.
Yeah. So, Pritesh, thanks for your question. So the guidance of mid-teen margin is for next financial year. So for this financial year, yeah. So
it is for FY24, the guidance for mid-teen margin.
That is correct. For this year, we are giving a guidance of mid-single digit revenue growth with earning leverage for this year. So there will be leverage by end of this financial year. Although the first quarter is still tough because last year we had a very high base of 25% growth, and also there is still a lot of opening up pressure. But for the year, we are confident of mid-single digit growth. Now, we do not know how long the opening up will continue. That is why we are giving this guidance of mid-single digit for the year. We may, if the situation changes, we may do better than this, but this is what we feel comfortable at this point of time.
This doesn't assume any significant revenue assumption from Germany?
Yeah, not a very significant. We are on the track of where we originally planned when we launched the channel, and we are confident by next financial year H2 it will be break-even. So we are not giving revenue guidance for Germany specifically at this time. It's still relatively small, but overall this does contribute to the overall sales. I can't say whether the local US and UK will be flat or a slight growth because we have not broken down in our guidance because it may change from geography to geography where the opening up may be higher or lower. Just to give an example, I'm traveling to UK next week, and to London the flight cost is 3 times I paid pre-pandemic. So the UK is really in an opening up environment right now. It may change from time to time, so we are not giving individual unit level growth guidance. But overall for the year, we are giving mid-single digit growth guidance for this financial year.
Okay. And my last question is, sir, on the budget pay side, where do you think it will stabilize? Because it has already reached about 39%, and it takes a slice of our cash flow. So where do you think will the budget pay number stabilize? If you could help us understand that.
Yeah, so we have around 40% is the approximate guidance we have for the budget pay. So we are still within the guidance. It can go a couple of percentages up and down. And during the little bit economic challenging time, giving budget pay is helpful for our revenue.
Okay. So if it is already reached 39, and if you are capping it at 40, which means incrementally we should not see it eating much into our cash flows.
Yeah, we don't expect it to go above 40%, but it can be 1% or 2% plus or minus. When we look at the daily and weekly numbers, we don't really pay as much attention to how much we have achieved so far. We look at what is right for the customer, what is right for the product, and the environment at this time.
And so lastly, the German business cost has already been baked into our P&L from the last 4 quarters. Is that correct?
Yes. So it is part of OPEX now.
Yeah. And Vinit was talking about a $6 million cost saving. I couldn't catch that. What is that, sir?
I'll take that, Sunil. So we undertook a cost optimization exercise across all the geographies, looking at the challenge in hand. So whatever measures we have taken in the last 3-4 months, we see an annualized saving opportunity of $7 to $8 million already from the measures taken. So that's what I was referring when I mentioned about the cost drive.
So it is reflected in the quarter 4 or it is going to reflect in the next 4 quarters?
So the full benefit will be coming in the next 4 quarters, and this is baked in when Sunil was mentioning that while the revenue guidance is mid-single digit, we also expect operating leverage to flow in the full year. So this will partly come from the revenue growth and partly from all the cost drives we are doing in spite of any inflationary challenges we will face.
Okay. Thank you.
Thank you. We have the next question from the line of Chintan Sheth from Sameeksha Capital. Please go ahead.
Thank you for the opportunity. Challenging period, I guess. If you can elaborate on, you did mention that the tailwind for last year was converted into headwind because of the physical movement, shifting the customer preference to offline shopping than online shopping. How much, that trend has an impact to the industry? Because I try to understand, when I look at QVC and other commentaries, their challenges are slightly different from what we speak about. We still, after 3 quarters, we still continue to blame the offline channel being, preference changing to offline shopping than the online, while they are facing challenges in the procurement as well as understanding what the consumer wants. So I'm trying to understand from your end what actually is impacting our growth.
Yeah, so thanks for your question, Chintan. So this is true. The QVC has supply chain challenges which we do not. We have it to a small extent because we have longer on transit time, and that builds up inventory to some extent. We don't have any shortage of inventory, but we have more cash tied up into that. So I do not know to what extent is the supply chain challenge versus the opening up challenge at QVC, but QVC Curate Group had substantial negative year-over-year growth, whereas we have positive growth and we are guiding for positive growth for the year.
So do you see this offline consistently, abating over the quarters from Q2 onwards when things start to reopen, and at the end of the 4Q, where we closed flat or 2.89% growth, the base is kind of likely to normalize from Q2 of next year. And despite that, and despite Germany getting into the picture, we are kind of revising our growth guidance lower, which means there is you foresee a structural demand impact. Obviously, inflation you've spoken about, but we did benefit from down training of providing a value proposition to customer, which eventually favors us compared to our peers. So I'm trying to understand your next year's growth guidance.
Yeah, so we already given guidance for next year onward in growth year over year. So we believe we're confident of mid to long term growth prospects for the company. Now, for the current financial year, we have opening up as well as inflationary or potential eyeball diversion due to other stories in the media and potential inflation. So all these 2 factors put together, we are giving guidance of a mid-single digit for the current financial year. If the situation improves, our performance will improve as well. Our effort has been to give prudent guidance to the street to the investor community, and that we have done for many years, for multiple years. Last year, we were not able to meet this guidance because of rapidly changing environment, and we are learning from that and giving more prudent guidance as we go forward.
Sure. And lastly, on the investment which we did for the HQ in Austin, how does it fit in terms of our capital allocation given the situation where we see clear or impending slowdown? How do we judge our capital allocation decision to invest in a larger HQ versus we could have reserved that cash for a weaker period, upcoming weaker environment in terms of business?
Yeah, thanks for the question, Chintan. As I mentioned multiple times, that we have very good cash throwing business. So it is a cash generating business. That is why we are confident and we continue to pay dividend, even if the performance for this quarter was not the best one. We have confidence in future cash flow of the business as well. So that is why we continue dividend as well as continue our investment into OPEX and CAPEX. We continue to make investments into better channel position, digital marketing, marketplace marketing, and the CAPEX in terms of a better channel position, digital infrastructure, automation in warehouse, and new headquarters in the U.S. Specifically to your question about new headquarters in Austin, we do that we have 3 buildings right now, and there is a rented building. Consolidating all under one roof will create more efficiency and cost benefit. So we did our ROI analysis for that premises. So we'll have positive ROI of going into our own premises.
And how much we paid for that?
So we paid approximately $12 million just for the land.
Okay.
And that will be constructed over the next 2 years. Will cost another $20 million or so.
Okay, for over next 2 years. Sure, I'll join back in. Thank you.
Thank you, Chintan.
Thank you. We have the next question from the line of Sameer Dalal from Natwarlal & Sons Stockbrokers. Please go ahead.
Yeah, hi. My questions actually are a continuation to the earlier questions on the margin front. So, if you look at slide 27, you all have talked about major OPEX investments where web marketing went up by 151%, marketplace is 38%, increased airtime OTA for 30%. And then if I look at slide 28, the margin hit because of this increased cost was about 2.2% because of the accelerated investment in digital and broadcasting. So my question is, are we going to continue at these higher rates for this part of the business, or this is for the earlier, or is this going to stabilize and come down a bit? What exactly is the plan of action?
Yeah, thanks, Sameer. Thanks for the question. For the digital and marketplaces, we see a lot of growth potential in those spaces. And once we get that customer in, and if we can convert that into multi-channel customer, the lifetime value of the customer increases. And we have multiple platforms that we can convert that customer into. Within our e-com space, we have web TV, and with live streaming gaining traction in US, it is very interesting for the viewers. We have Rising Auction, the $1 auction platform, that also gets customer addicted or hooked to our digital platforms. And we have other additional potential to target that customer to OTT platforms on Fire TV, on Roku, on and Samsung, Hisense, all the smart TVs, so that value addition of the customer is high. That is why we are making the investments to continue to acquire these customers, and so that we can transition them and gain into the lifetime value of that customer. Having said that, the investment we made the last financial year in US, UK, Germany on digital may be at same or slightly lower number than last year. But with your model, you can design around similar levels for this financial year as well. From an absolute dollar perspective, not the increased mid-single digit growth, but an absolute dollar terms.
Sure. If I can ask you another question related to this, you talked about the fact that you can get a lot of customers onto your platform, which can be used and then help retain these customers. Can you give us some idea of what kind of additional customers you have got because of these additional spends?
We don't have a separate breakup, Samir. The numbers that we shared of new customer acquired is mix of TV, OTA, TV, OTT, digital, and customer transition from marketplace over to us.
Correct. But my question is there any way to quantify if these spends are actually bringing in the kind of customers that we need, or?
Yeah, we look at it constantly, and we look at what is the ROAS we're getting from each channel. We have now 3 different channels, US, UK, Germany, and within these each, we have social, we have Google search, we have Bing, we have influencers, we have affiliate marketing. So each have their different criteria for judging what ROAS should be from each of them. So we constantly monitor and modify our marketing strategies.
Okay, one of the other reasons for the margins to be lower this year was, of course, the sea freight elevated prices. Given that we've had this, are we taking any price increases to offset this? What exactly are we doing? Because they still remain elevated, if I'm not mistaken.
Yeah, they've modified a little, they've moderated a little bit, but they still are elevated. But as you have seen from our gross margin basis, so we are able to pass on majority of that to our customer and get to our gross margin of 60%+.
Correct. So any more price increases we can expect for any of these cost increases that we are facing, or, I mean, that's not something you are looking at all?
Well, inflationary pressure is there, Samir. That is everywhere.
Correct, that's my point.
Component, it is going to be there, as per the analysis, going to be there for all of this financial year. So, but the good thing is that we can pass on to the customer because we are not logged into a particular product. We bring in 150, 200 products every day, new products every day. And within that, we are able to build up the margins. And the product which has really gone out of cost, we discontinue. So we are able to do the price adjustments across our selling platforms.
Okay, now coming back again to the similar kind of question that your first person asked. You know, you've given us mid-single digit growth guidance, and we've talked a lot about the fact that our channel upgrade from 50 to 22 in UK is going to actually bring a lot more customers on board. So is that view now a little bit changed that this year it may not be the case, or the two statements are not gelling together where we say that we'll get a lot more eyeballs, but then it also says that we're not going to be able to translate those eyeballs into customers. So I'm just trying to get a feel on why we are being so, I'm not saying pessimistic, but so conservative on giving a growth guidance.
So the first point about UK channel. So UK channel, when we launched this, there was in January. Yes, we launched in January, the middle of January. So at that time, the UK TV customer acquisition was trending about 20 to 30% negative year over year. So as of May, this first 20 days, we are seeing about 8% growth on TV acquisition year over year. So we are seeing new customer coming in from TV, and that is valuable customer. The lifetime value of the customer is high compared to even web customer. But how the buying behavior of that customer will be given the macro situation, the customer going out, or the inflationary pressure or the recessionary pressure that might happen, we are conservative on giving that.
Okay. And the last question I have is on the inventories. We've seen a big jump. Last quarter also you talked about the fact that inventories were higher because sales through didn't happen. And of course, we have seen inventories go down from, I think, last quarter to this quarter. But what would be the comfortable level of inventory that you would be happy to sit on, or would this be the new trajectory for the inventory levels at about 620, 640 crores odd?
Yeah. So inventory level was mid high this year compared to last year. So what we're looking forward is to moderate that and not take hard right turn or hard left turn, but moderate it over this financial year. So we are not giving specific guidance on inventory, but this will be it will be lower in in terms of number of days, as also in absolute dollar terms.
Sure. Thank you very much. I'll come back in queue if there are more questions.
Thank you, Samir.
Thank you. We have the next question from the line of Sabyasachi Mukherjee from Centrum PMS. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is, kind of a follow-up to one of the previous participants. Is, if I looked at your OTT digital spends, over the last 4 quarters, it has ranged around, 14-15 crores in a quarter. Whereas if I look at the OTT revenues in one of the slides that you have put up, it's around 14 crores, $1.8 million, 14-15 crores quarterly run rate in the last 2 quarters. So where do you set this benchmark of, let's say, spending 1 unit in the digital or OTT space, and how much do you get in return in terms of the revenue from that particular OTT customer? And do you have some kind of quantification in this regard?
Yeah, thank you for your question, Sabyasachi. So the 25 crore in Q4 is a digital marketing spend and not OTT. OTT is a very small subset of the digital spend. We do spend on, say, Fire TV and Roku to get our apps on those platforms downloaded, but that is a very small subset. And whereas now the sales number you picked up was only OTT. So to the earlier question from Samir I answered, we would have overall digital spend about similar or slightly lower spend for this financial year, given the current productivity we are seeing on digital spend. If we can get to higher productivity of the spend as we are learning every day, or as we are going into new platforms, for example, we are going into TikTok now. If you see higher productivity on that, we can increase our spend over there. So the current projection for us to spend about similar level or slightly lower than last year in absolute dollar terms.
No, so just to understand this thing, so if you, let's say, if you spend $1 in digital, so how much does it yield in terms of revenue?
Yeah, so there are 2 components of that. So one, revenue you get right away. So within the digital spend, we have 2 kinds of campaigns. One is to acquire new customer, which gives lower revenue right away, and other is to get revenue right away, the ROAS right away. So within those 2, it changes from channel to channel. For example, the social revenue ROAS is lower than Google. Google is higher. Within Google, there is search, there is shopping, there is remarketing, and there's banner ads. Then there is affiliate marketing, and there's influence marketing. And brand to brand differs. Germany, UK, US, and our 2 new digital brands. So the ROAS differs from channel and to the tactics to the verticals, and within verticals, different, whether it's to customer acquisition and or to get the sales from that. So I don't have an overall number, Sabyasachi, because it's too amorphous number there, it might be. But we constantly review the tactics or the strategy in terms of what productivity we need to give.
And out of these,
one number answer on that, because it's pretty complicated mathematics or analytics, or what do you say, the calculations we do on a weekly basis.
Okay. My next question is, of course, we have seen, volume decline in TV in FY22, and web volume growth of hardly 1%. So, where do you see the TV volume and the web volume growth in the next, probably not I'm talking about FY23, but for the next 2 to 3 years, where do you see this number?
Yeah, so that's a good question. So last few quarters, our volumes have been moderated because the pull at this time of the customer is of slightly higher price point. For example, the plain gold chain sold very well in recent quarters. Probably for inflationary pressure, for whatever the reason, they did. And lower to mid price point was a little moderate pull from customer. Probably because of low number of eyeballs watching us, people going out. So we are able to, with our agility in supply chain and our new product coming in, velocity is very high. We moderate, we modify, and serve customer what they look. Our guidance for coming year, I would encourage you to look at the current financial year ASP as a benchmark for last financial year ASP as a benchmark, and build your model with mid-single digit growth on that ASP.
Okay.
And have similar volume growth. No, let me take it. So have similar ASP for current financial year as last year ASP, and grow volume in mid-single digits on that.
Okay. Last question, bit of bookkeeping one. So I see the packaging and distribution expense in Q4 being higher than Q3 despite our revenue going down. Why this have happened? Can you explain?
Yeah, I'll take that, Sunil. So packaging all depends a lot on the products being sold, the mix of the products, volumetric, etc. Plus there are also impact of the fuel surcharges, peak season surcharge, and so on and so forth. So it may not be apt to look at quarter by quarter number. Our recommendation would be to look at year by year for the same. So for the quarter, it grew by 4% in spite of all the rate increases, etc., which has happened during the year. As I was mentioning, and you would have noticed in the presentation as well, so we have undertaken a lot of measures in this shipping and packing cost already, which should give us at least a saving of around $2 million for the year.
Okay. Thank you. That's all from my side.
Thanks, Abhishek.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Ashish Shah from Business Match. Please go ahead.
Hello, sir. Thank you for taking my question. Sir, on slide, this is 28, where you have mentioned, the major capex investments done in FY22. So can you talk a little bit about your investment in the 2 D2C brands that you did in FY22? And, you mentioned in the earlier calls, I think a couple of quarters back, that you are experimenting going D2C brands. So any early thoughts on, how has the experimenting and testing gone, and how do you see this future?
Yeah, thanks for the question, Ashish. These 2 brands we are slowly ramping them up. It would have been, if we had not as much opening up as we've seen, we might have ramped them up quicker. So we are ramping up, but slowly, so as not to burn cash and keeping our guidance of this current financial year giving leverage. But we are learning quite a lot from them. The revenue is not going to be substantial. Both brands put together this year would be just around between $2 to $4 million. So it's a very wide range we are giving because we are still moderating and looking at without burning much cash if we can increase customer acquisition, retention, and repeat. So it's still experiment and testing.
Sure, sir. That's very helpful. And so just one just bookkeeping question. Any capex guidance for the next year and for FY23 and 24?
I'll take that one, Sunil. So we don't give any capex guidance as such. Sunil mentioned about the land and building expenditure, the headquarter one for US, which will be spread over next 2 years. We expect that to be completed in H2 of FY24. But that will be about, say, $20 million spread over all these 2.5 years. So that will be an additional capex. But other than that, we have done a significant capex expenditure in the last year. We expect our capex, other than the land and building one, to be moderate only for the next 2 years, maybe in the range of 50 odd crores, which we used to have year prior to the last year. But yes, if any substantial opportunities come our way, we would not shy away from investing there.
Sure, sir. Thank you, sir. That's all.
Thank you. We have the next question from the line of Chintan Sheth from Sameeksha Capital. Please go ahead.
Thanks for the follow-up. On the channel upgradation, how much we have spent, and this is capitalized, I guess, and if we capitalize, for how many years we need to amortize it?
Yeah, Chintan, we have spent 74 crores on these broadcasting rights, and we amortize it over 15 years.
Over 15 years. Okay. And yeah. And second on, if I look at the OTT numbers, the customer, there will be repeat element, I guess, but the average customer, revenue per average customer, it seems to be little high, over $500. Obviously, there will be element of repeat purchase, and we don't know the volumes there. But that is typical to other channels as well?
Sorry, Chintan, can you repeat the question, please?
So the OTT revenue, we from the chart, we can make out that we made around 1.8 million for the fourth quarter, and we have around 3,000 to 3,200 customers, unique customers with us. So average works out to be around $500 plus dollar revenue. Obviously, there will be repeat purchases and units will vary. But does that reflect with all other platforms we have, that the per customer revenue works out to around quarterly on a $500 kind of number?
Yeah. So for OTT is generally one group that we say. The other, like e-com is different, TV is different, and the customer who buys from TV and e-com is very different. So
okay.
Just for OTT, and customer overall for the retention and the lifetime value is pretty high on OTT, as you saw in our presentation.
Right. And secondly, I was looking at the per unit, expenses. You mentioned packaging and distribution, but broadcasting cost as well as other OPEX. Anything in the other OPEX part which seem to absolute numbers remaining flat, but I think there is some element of higher cost. Any provisioning or anything we did this quarter?
I'll take that, Chintan. So packaging, I already spoke about, shipping and packaging. Content and broadcasting includes the airtime and the web marketing largely. So
okay.
We have been speaking about that. So web marketing is higher, and that's a conscious investment. Airtime expenditure is higher also year on year by 30%, but that's also in line with the investments we made in the various OTA homes during the year. Like Sunil was mentioning, these two expenditure will not now substantially increase in the current year, both web marketing and airtime. Of course, any significant opportunity comes in airtime in OTA homes, we may opt for that if it makes sense for us. Other than that, there is no significant increase in any cost in terms of like jump in the quarter. And one correction, Chintan, the amortization of the TJC UK channel is 10 years and not 15 years.
Right. One last question on the Austin office. The 3 centers currently you have. what kind of annual rental saving we can expect beyond FY24?
I'll take that. So when we modeled it, so we found, I will not speak about the rentals alone, but all OpEx put together, we should get a OpEx saving of about $1.5 million per year.
Sure. That's all from me. Thank you.
Thank you. We have the next question from the line of Ritik Tulsia from Concept Investwell Private Limited. Please go ahead.
Hello.
Hello, Ritik.
Yes, sir. Am I audible?
Yes.
Yes, sir. So my first question is, sir, there has been changes in the leadership team. So any specific reason for those changes? Also, are they hired from outside or they were a part of VGL team earlier as well? And I'll answer next question after this question has been answered.
Yeah, so the change is a fact of life, Ritik. So sometimes we just leave for better opportunities. Sometimes we take a decision for various reasons. So we are looking internal as well as external for replacement of these positions.
Okay, sir. So, and my next question is, so the e-commerce industry itself is facing headwinds in UK and US. And in case of television, I believe the headwinds are even stronger. And substantial part of business comes from television. But you mentioned we are gaining market share in it. So is it that the industry is degrowing, but we are gaining market share? So can you provide more clarification on that aspect?
Ritik, you are not clear in your question. Can you repeat? And your voice is a little bit echoing.
Just a minute, sir.
Yes, so my question was, e-commerce industry itself is facing headwinds in US and UK. And in case of television, I believe the headwinds are even stronger, like you said. And substantial part of business comes from television, but you mentioned we are gaining market share. So is it that the industry is degrowing itself, but we are gaining market share over there? So a little bit clarification would be beneficial for us, sir.
Yeah, so when the growth of earlier year was very, very high, and if there's a change in customer behavior, you have to look the trend in a longer perspective. That is why we gave the number of FY20 as well. So for us, we continue to gain market share, whether the industry is gaining rapidly or for external circumstances is not showing growth. So we will be having growth of market share in any circumstances.
Okay. And my last question is, sir, that how should we look at the TV business going forward? So anything on that aspect?
Can you repeat the question, please?
Yeah, I was saying, how should we look at the TV business going forward? So, like, do you have any plans in mind which you can share with us?
Yeah, so we look at TV business for us as a long-term business because our market share is just about 3% of the listed players that is we see the financials from. And also the OTA homes, the over-the-air free antenna, that side of business is growing, and we are gaining more and more homes into that space. So there is a cord cutting happening on the cable side, but our market share is small, so we can continue to grow in that space. And OTA space is growing, and we are gaining more and more space, customer share in that space. So for next 7 to 10 years, we don't see a reason to be concerned about TV, the linear TV. Having said that, we are making appropriate investments into OTT space, that is connected TV, smart TV, or the on-top set-top boxes, as well as on digital and social. So on all put together, we are confident of our long-term growth, irrespective of the platforms.
Okay, sir. Thank you so much for answering the question.
Sure. Thank you.
Thank you. We have the next question from the line of Aditya Mehta from GK Capital. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So my question is regarding manufacturing units which we have set up few quarters back for the manufacturing of apparels. So how is that unit scaling up?
Yeah, very well. We have a good number of people. We need some additional small capex for improving the machines and processes. So we are happy with the progress. We are happy with the apparel progress on our TV channels also. So we are generally happy with the progress on that.
So how much of the revenues we are generating from that unit?
So I don't have the specific revenue. It's not a whole lot, but it is as per our projections.
Okay. And so for FY23, how much loss are we anticipating from our Germany operations?
So we are not giving specific loss guidance on that. It will be lower than what it was last year. And in H2 of FY24, we expect it to be profitable.
Okay. And for FY23, what was your EBITDA margin guidance?
So for the current year, we are not giving any EBITDA guidance. We mentioned that we will deliver positive leverage for the current year. And what we are mentioning is that for the next year, which is FY24, we believe we are confident of our EBITDA margins to come back to the mid-teen levels, which you saw in FY21.
Okay. Okay, that's it from my side. Thank you, sir.
Thank you, Ajit.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Sohail Kamdar, an investor. Please go ahead.
Hello. Thank you for taking my question. In the expense item and the content...
Mr. Kamdar, I'm sorry to interrupt, but the audio is not clear from your line, sir. If you could adjust the instrument.
Sure. Hello. Yeah, is it audible now?
Yes, it is. Thank you.
Okay. Thank you for taking my question. In content and broadcasting, I'm seeing that the expenses for the full financial year is increased by almost 35%, whereas the revenue has increased by only 8%. So how should we see that? Is that mostly an operating expense or it's a variable? And how it is linked to the sales?
Yeah, so we made some investments into OTA space. And we found that investment to be productive for us. For the current financial year, we should look at similar number. And the last year's number that we had, last year investment that we made, are on the track for meeting our cadence. So from absolute dollar point of view, you should plan your model based on similar numbers last year.
Okay, so absolute number would be similar as last year.
Yes.
Okay, thank you.
Thank you. We have the next question from the line of Pooja Doshi, an investor. Please go ahead.
Thanks for taking my question. So I wanted to know that
Ms. Doshi, this is the operator. I'm sorry to interrupt, but the audio is not clear from your line, ma'am.
Okay, is it better now?
Yes, please go ahead.
Okay, thanks. So, current quarter inventory being high, I wanted to understand if there are any obsolete, non-moving or slow-moving inventory, and if you can quantify the same.
Yeah, thank you for the question, Pooja. So we have the provision, process of exiting the tails or slow-moving inventory through clearance mechanism and our rising auction. So we don't have much of non-moving, and whatever the inventory which should be slow or non-moving, or whichever is aged inventory, we have a provision created for any aged product. So the value of the inventory continuously goes down as per our cadence. So we are confident of our quality of the inventory over the long term, over the course of this year, to be able to reduce absolute dollar terms or rupee terms, to reduce the inventory this current financial year before the end of the year.
And also, if you could help me understand that process of identifying a bad inventory and writing it off. Like, what would be the exact process to do that?
Yeah, so we have about, at any given time, we have 60,000 SKUs in the system. So we have an automatic system algorithm of product. If it is lower than expected productivity, it goes into either clearance flag or goes to rising auction flag. And from there, it sweeps out to automatic scheduling of the product for a customer to bid on. And we start those such product at $1, and it ends wherever it ends. And the customer gets that product. And if it is aged product beyond a certain timeline that we have, and it has cadence from certain time to certain time, and keeps on depreciating over that time. So we have a very robust mechanism in the company to create provisioning as well as exiting of each product.
All right. And so what would be the trend of return to sales ratio? If you could help me with the trend for last 8 quarters and particularly this quarter.
Your question wasn't clear. You were going in and out.
Okay. So could you help me with the trend of returns to sales ratio for last 8 quarters, if you have those numbers handy?
Yes, it's pretty constant. We haven't seen returns going up in last quarters. It's fairly constant.
And what would the range be then?
So for US, it is around between 16 to 18% returns. For US, is about 25 to 28% range.
We understood that it has been consistent since the last couple of quarters is what I'm saying.
Sorry to interrupt. This is the operator. Pooja, your audio is breaking.
Okay, I'll try again. So you said this has been constant since last couple of quarters, right? The 16% number and 25% number you said.
Yeah, so US is between 16, 18, 19%, and UK is from 26 to 28%.
Okay, perfect. And so lastly, I wanted to understand shipping and freight cost as percentage of sales. What would that number be for this year?
So in absolute dollar terms, it will grow maybe in line with the volume growth, and you can factor in the $2 million saving which we are projecting for the year.
Okay, all right. And so lastly, on seasonality, is there any seasonality in sales? Like, usually a lot of companies have inventory build up during Q3. So do you have something similar, or it's even throughout the quarter?
Yeah, so there is seasonality in the sales, but jewelry is not a lot of seasonality. It's mostly self-purchase, and it sells for pretty much all year round. There are sometimes some colors, for example, in some gemstones like smoky quartz or black onyx, that sells more into winter times than the summertime. Summertime or springtime, some lighter colored gemstones sell better. Now, in apparel, there's some summer fashion, some is winter, fall, so there is a difference between these. But for our inventory makeup, after our provisioning policies, we don't have any concerns with overall inventory.
Okay, all right. Thank you so much for answering all my questions, and all the best.
Sure, Pooja.
Thank you. We have the next question from the line of Siddhant Dunn from Goodwill Warehousing. Please go ahead.
Yeah, hi. I just wanted to, understand that because shipping costs and all, have been going up. Have they been going up for us? And because we are in the lower ticket size, does that way lately in the last few quarters with inflation going up?
Your voice was in and out. Can you please repeat the question?
Yeah. So you answered in the previous question about the shipping costs, being in line with the volumes. But because our ticket size is lower, does it affect us in a way? With inflation, especially with shipping.
No, like I said, you can project our shipping cost in line with the volume growth and factor in the savings for that. So.
Okay, so it's not a major issue.
Okay, it's not a major issue.
Okay, perfect.
Mr. Dunn, does that answer all your
questions? Yeah, that's it.
Thank you. Ladies and gentlemen, that was the last question, and we will now close the question queue. I would like to hand the conference back to the management for closing comments. Please go ahead, sir.
So I want to thank all the participants for your time and great questions. And I also thank you for your support to Leisure in past years. If you have any further question, feel free to reach to Prashant Sar VGL or Carl Kola at CDR India, and we'll be happy to answer your questions. Thank you once again. Over to you, Melissa. Thank you.
Thank you, gentlemen of the management. Ladies and gentlemen, on behalf of Vaibhav Global, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.